Okay, ethics is huge on the CPA exam. It's a for the auditing section, it's about 20% of it. So we're gonna spend a little time on this one, and it's arguably it's the biggest one, the biggest chapter in the book. But basically, ethics, a big part of it's focused on independence. The only thing that we give to the financial statements is credibility, and we have to have independence to do that. And that's what makes it auditing such a weird profession. That you have to be independent from your client. You can't do an audit of, say, your sister's books for her company or whatever, because it has to be independent. And so that's kind of a strange thing. That's different than almost any other profession, is that we have to be independent. And when it comes to doing an audit, we're really not there to try to necessarily help our client. We're not there to make them more profitable or anything like that. It's simply to do the audit of the financial statements. That's how you're helping them. You're helping them by giving them an independent, unbiased audit of their financial statements that they can take to someone and say, oh, look, here's somebody who's independent, who looked at this and wrote this report. So you're not there necessarily to try to help your client with their business. You're not trying to be negative and trying to hurt them or anything either, but you're there to give them an independent report that they can take to other people. That's how you're helping them. Okay, so you have to be independent, and that's what a good chunk of this whole chapter is about. And the first thing we're going to learn is covered members. Who in the audit, who in the CPA firm is going to be held up to a higher standard? So covered members, the term comes from being covered by the independence rules. And they have a higher level of independence than other professional staff in the CPA firm. Okay, so these covered members are special. Not everybody's a covered member. Some people are, some people aren't. But this is, so first we're going to go over and see who is a covered member. Who must have these higher standards that are going to be held to them. And I will say that there's covered members and non-covered members, and that the covered members are the ones that are held to the highest standards. They're the ones that are sort of like the main focus of this whole thing. There are standards for people who are not on the audit, who are not covered members. But there's two levels. There's the covered members, which is a real thick layer, and then there's the non-covered members, the people who are not covered members, who are not going to be held to the higher standards. Okay, so who is a covered member? Well, all of the partners in the audit engagement office. I'm gonna make that green. Let's make it green. So whatever office is doing the audit, so let's say the Chicago office is doing the audit, every partner in that Chicago office is a covered member. Everyone who is on the audit is also a covered member. So if you're on the audit engagement team, you are a covered member and you're going to be held to a higher standard. Now notice that not everybody in this, in this engagement office, this audit, whatever office is doing the audit, not everybody is a covered member. These other people are not. So associate 1, they're not a covered member. Manager 2 is not a covered member. So a lot of these people aren't, but ones who are partners and the ones who are on the audit itself are going to be covered members. Okay, there are other people who are covered members. And this is what people who kind of do the consulting end of the business. In the consulting side, these are non-attest services. So these could be like taxes. This could be if they're doing something with importing stuff or whatever it is. These are people that are covered members. Only the partners and managers. Right, so the audit engagement team, they are covered. The partners in the firm for whatever the office is that is doing the audit, there are covered members. And only the partner and manager of the non-attest. So if this was, say, tax accounting, only the partner and manager, the senior, the associate, everybody else in this place, the other partners, they're not considered covered members. Okay, so this kind of encapsulates the first 3 we have down here. So members of the audit engagement, all partners, and then for C, and I got to talk about them a little bit. Now, partners and managers in non-attest services. Okay, and there is a kind of rule here for those non-attest services. Okay, so non-attest services, those are like consulting, those are things like taxes and things like that. So let's say they do some tax returns for them or tax work of some sort, whatever it is. All right, here is the kind of ruling on that, in that they have to provide at least 10 hours of billable service during the year to be a covered member. So they have to do at least 10 hours worth of work for this client to be a covered member. If they don't do 10 hours, let's say they do 7 hours worth of work, they're not a covered member. These are often called 10-hour people. They have to be, consulting people have to do at least 10 hours of consulting to be a covered member. If they don't do 10 hours, they're not a covered member. They're not going to be held to the higher rules. So everybody who's a partner in the office, everyone who's on the audit engagement itself, and the partner and manager of any consulting, if they have done at least 10 hours worth of work. Those are the 3 main groups of people. Those are the people that can influence an audit. So those are the people that can most directly influence an audit. Partners can influence audits. People on the audit engagement can influence audits. Consulting people can influence audits. So those are the people that need to be really independent. Now, there are 3 more categories that we're going to talk about. Okay, so who else? Anyone who can influence the audit. So this is kind of a catch-all, that if there's someone that is not listed there, but they can influence the audit, for instance, the senior partner, they are a covered member. The CPA firm itself is a covered member. So, the CPA firm, maybe they have a retirement plan. They cannot invest in, let's say we're auditing IBM. I know I always use that company, but let's say they're auditing IBM, and can they invest in IBM? No, they're a covered member. If they do invest in IBM, the entire firm is not independent. So the CPA firm itself has to be. And the last one here, F is kind of there to take care of any one trying to circumvent these rules up here. Any entity that is controlled by covered members. Now, the control is in total of covered members. So for instance, if you had 3 people who are covered members and they wanted to invest in IBM, they could say, oh, let's form a partnership and we'll invest in IBM. And because there's 3 of us, I'm not in control of it, you're not in control of it, they're not, it's in total. So if covered members are more than 50% owners of this business, then that business itself is a covered member and and can make the entire firm not eligible. And not be can ruin independence for the entire firm. So anything that is controlled by covered members. Now, if covered members own 25% of a business that invests in IBM, they don't control it, it's okay. But if they control it, if there's more than all of the covered members together who are invested in this thing, if it's more than 50%, then that business itself is also a covered member. Okay. Question on that? All right, well, let's see how this all works out. So financial interests of covered members. Financial interests, so investing, say, in their stocks or bonds or something like that. Direct financial interest is prohibited regardless of materiality. Let me highlight that. So direct financial interest, so any direct financial interest. Oops. Owning 1 share of stock is prohibited. So direct financial interests are a no-no. So if we're owning IBM, no covered member can have even 1 share of IBM stock. Indirect financial interests, and I'll talk about these in a second, about what they are. Indirect financial interests are allowed if they are immaterial. Okay, so indirect financial interests are allowed if they are immaterial. Now, what is an indirect financial interest? Okay. Indirect financial interest example. Okay. Owning stock. Oops. Owning the stock of a bank. So owning stock that of a bank that loans money to the client. So owning stock of a bank. So for instance, let's say that you invest in Bank One. Bank One loans money to IBM. That's indirect, right? You're investing in the bank. The bank is investing in IBM, and that they're giving them a loan, presumably with the idea that the loan will be paid back by the client. So it's indirect. There's the bank in the middle, basically. Okay, so that's an indirect interest. Owning stock in an S&P in a mutual fund. Owning stock in a mutual fund that invests in the client. So you buy shares of a mutual fund. The mutual fund takes that money and maybe buys a lot of different shares. An example of this would be, say, a Standard & Poor's 500 fund. Standard & Poor's 500 fund is something that would say they take the 500 largest companies, and maybe one of those is IBM. I think it would almost have to be. And so there's 500 companies in there, and the Standard & Poor's 500 fund will take your money. They give you shares in the Standard & Poor's 500, and then they take that money and they invest it in a bunch of different, 500 companies, and then those 500 companies, one of them is, say, IBM. And again, as long as it's immaterial, that's fine. And if you think about it, let's take a Standard & Poor's 500 fund or even a 100 fund. Well, let's take the 500 fund. It's going to be immaterial. There's IBM's in there, but there's 499 other companies in there. So whatever happens at IBM probably doesn't have a huge impact on the overall value of this fund. There's 499 other companies in it. So that's the idea behind it being indirect and immaterial. So it has to be, if it's indirect and immaterial. Okay. Let's go through these. So cases, number one. Gina is a member of the audit engagement. She owned 5 shares of IBM stock, and this ownership is immaterial to Gina. If I can hold this. Doesn't mess up too much, I guess. Okay, is Gina a covered member? Anyone? She's a member of the audit engagement team for IBM. Is she a covered member?
Yes.
Yep. Yeah, they don't say where she is, but she's one of these people here, so she is a covered member. She owns 5 shares of IBM stock. Is this direct or indirect? What do you think?
Direct.
Yep. Direct financial interest. She owns her stock. So this is going to be a direct financial interest. And they tell us that it's immaterial. Is Gina in violation of the independence rules?
Yes.
Yep. She cannot own 1 share of direct interest. Even if it's even 1 share is prohibited. If it's direct. Okay. So Gina is in violation. Okay, let's go to Greg, see what Greg's up to here. Oh, I just talked about this. Greg is a member of the audit engagement team. Is Greg a covered member? Yep. Same as Gina. Gina and Greg are the same. They're both covered members. He has investment in an S&P 500 mutual fund. Because IBM is in the S&P 500, the mutual fund has a direct interest in IBM. Okay, so is this a direct interest or indirect?
Indirect.
Indirect, good. The fund has a direct interest, but Greg doesn't. Right? So, Greg doesn't have a direct. The mutual fund does. If you mutual fund buys shares of the stock, but Greg doesn't have that. Greg just has shares of the mutual fund. There's 499. Most likely, well, it's one of 500 companies. Is this material or immaterial? What do you think?
Immaterial.
Material. Good. So it's not material. Is Greg in violation? So we're here. Ah. Oopsie daisy. What's happening here? Hold on. Okay. So is Greg in violation? It's indirect and it's immaterial.
No, he's not.
Nope. He's not in violation. Helen is not a member of the audit engagement team. However, she is a senior auditor in the engagement office. She owns 500 shares of IBM stock. This investment is material to Helen. It might be material to Heaven. I don't know, but it's material to Helen. Okay, so is Helen a covered member? So she's a senior auditor in the engagement office. Let's go up to the engagement office. So she's a senior auditor in the engagement office, but she's not on the audit. So I don't know, maybe she's senior 2, okay? I don't know what senior she is, but is she a covered member?
No.
Nope. So if this is Helen, she's a senior, she's in the engagement office, she's not on the audit, so she's not a covered member. Okay, let's go back down to her. Way down here. Okay, so she's not a covered member. The interest, is it direct or indirect? She owns 500 shares of IBM stock. Is it a direct interest or indirect?
Direct.
Yep, direct. And they tell us that it is material to her. Is Helen in violation of the independence rules?
Would it still be yes because she works for the engagement office?
In this case, it would be actually be no, because these rules are only for covered.
Okay.
So oddly enough, it is no. She is not in violation of the rules. So notice the difference between people who can influence the audit and people who can't. Here she is. She's a senior, but she's not on the engagement team. She can't have any control over the audit or anything like that. So she is not covered by these rules. These rules are only for the covered members. Oops. And even if it's material to her, which it is, not a covered member, the rules don't apply to her. I will interject here just one thing we will learn about later, and that is if there are rules if you have a large direct, if someone who's not a covered member has a large direct financial interest, there are rules about that. It's got to be more than 5%. We'll get to that later. There's no way that 500 shares is 5% of IBM, but there are limits to it, but they're very large. If you own 5% of IBM, you have your own private jet and stuff. Probably wouldn't be working at a CPA. Probably be working at a CPA firm, but anyway. Okay. Now, immediate family members. So, immediate family members, this is to get around someone saying, oh, okay, I know, I will give all my stock. I own stock in IBM, I want to do the audit. I'm going to give it to my spouse. I'll get to my husband or get to one of my kids, right? I don't own it, they do, to get, and, kind of a loophole in the rules that, I wonder if you have an immediate family member. Well, immediate family members are also, they're considered the same as the covered member. So any immediate family members that own the shares of stock, those are also considered to be the member themselves. So who are the immediate family members? We have spouses, spousal equivalents, how do you spell that? Well, and dependent children. basically anyone that you see when you go home at night, those are going to be your immediate family members. Clean this up a little bit. So, spouses, spousal equivalents, dependent children are considered to be covered members. Spousal equivalents could be, it could be, live-in girlfriend, boyfriend, could be sometimes, for the, you have a gay marriage, and some states may have a gay marriage contract rather than a, whatever it is, whatever. There's also common law, like common law, marriages. If two people live together for a certain period of time, it's considered a marriage. And even though maybe the federal government doesn't recognize that, as auditors, anyone who is, in that capacity is considered to be the same as the covered member. All right. So the rules here, they're a little bit different. We have the US rules, and then there's international rules for this, and we'll talk about those. Okay, so let's go down here to the cases. Okay, Sharon is a member of the audit engagement for IBM. And I'm going to fill this in myself. That's a covered member, right? If you're on the audit, covered member. She does not only own any shares of stock, but her husband owns 10,000 shares of IBM stock. Okay, is the interest direct or indirect?
Direct.
It's direct. And now, is it material or not? I would say 10,000 shares are material. However, it really doesn't matter. Let's jump right down to, is Sharon in violation of the independence rules?
Yes.
Yep. And 10,000 shares, or if her husband owns one share, it doesn't matter. I would guess this is probably material, but we really don't even have to make that judgment. If this was he owns one share, it's considered the same as the covered member. The covered member is not independent. Okay, Steve. Is a member of the audit engagement for IBM. Okay, so we're looking at a covered member. He does not own any IBM stock, but his daughter owns an immaterial amount of IBM stock. Okay, so he's a covered member. Is the ownership direct or indirect?
Direct.
Direct, good. It's tempting to say it's indirect. No, it's through his daughter, but he and his daughter are one and the same. The dependent daughter is the same as, as Steve. The amount is immaterial. Is Steve in violation of the independence rules?
Yes.
Yep. His daughter is considered the same as him, and since she has direct interest in the stock, it really doesn't matter whether it's material or immaterial. One share will do it. This one's tricky. Jolene. is a member of the audit engagement for IBM. Okay, so Jolene is a covered member. She's on the audit. She does not own any shares of IBM stock, but her husband has a large investment in a technology fund. 40% of the technology fund's holdings are IBM stock. Okay, this one's a little bit, a few things going on here. So is this a direct or indirect interest?
Indirect?
Indirect, good. Is it material or immaterial?
Material?
Why material? This is a large investment, they say? A large investment. So this is probably material. And 40% of this fund, a good chunk of this fund, is IBM stock. And so obviously if IBM does well, 40% of the fund's going to do well. It's pretty. Okay, so is Jolene in violation of the independence rules?
No.
Actually, yes, because to be, if we deem this to be immaterial, she would not be. But because it's material, wrong place. Hold on. Indirect financial interests are okay as long as they are immaterial. If they become material, like the Standard & Poor's 500 fund, it's one in 500 companies. If it becomes material, then it is a no-no. That's a technical term, by the way, a no-no. So anyway, she would be in violation of the rules because it's indirect, but it's most likely material.
Why is it considered indirect interest?
Because it's a good question. It's in a technology fund. So in other words, her husband, they don't give his name. Her husband owns the technology fund. He doesn't directly own IBM stock. So the technology fund is sort of like in between her husband and the investment. The technology fund has a direct investment, but her husband does not. He owns the part of the technology fund. The technology fund owns 40% of their ownership of that fund is tied up in IBM stock. And again, the key on this one is that it has to be material. If it was not material, you say, well, what is not material? If it's 5%, what? Those are all judgment calls. But if it is material, it's a yes. She's in violation. If it was not material, if it was immaterial, they own 1% or whatever of IBM, then it would be a no. So it's key on the material. And again, this is kind of a judgment call. Okay. All right. Close relatives and friends.
Professor?
Yeah.
In terms of material and immaterial, does that have to do with the percentage of stock they have?
Most likely percentage of stock and how big of the investment. Now they tell us that this is a large investment, so I'm assuming it's large to Jolene, large to her husband. They say it's a large investment. If they said it was a small investment, and it's indirect, it could be very well immaterial. I'm sorry, popped up on my screen. I don't know if you can see that or not, but every now and then Adobe tries to update and always tells me that it fails. I wonder why it keeps trying. But anyway, no. So that if the investment was a small investment, say, it would probably be immaterial, even if the indirect interest to the fund was material. So for instance, let's say they put $100 in this fund. Okay, it's probably not going to be material, even if there's 40% of it's owned by IBM. But they make a large investment, $10,000 they put in. Okay, now they got a pretty big size investment, and a lot of that investment is keyed on the price of IBM. So it'd be a combination of how much they have in it and what percentage it is. Yeah, those would be the two key components of it. So it has to be, a material investment and, indirect, but a material investment to whoever it is, and that would depend on the size of it. And yes, it's a judgment call. There is no 5% is okay, 6% is not. They simply say whether it's material, and it is open for judgment whether it is or not. I'll tell you what happens at CPA firms, though. When you join as an auditor, they will give you a list of all their clients, and they'll say, "Do you own, stock in any of these clients?" And if you do, they say, "Oh, well, here, today's the day you sell them," because they don't want to have any of the possibility of that leaking over and being part of their problem. So a lot of times CPA firms will actually have a list of clients and say, do you have any direct interest in any of these, or do you have indirect interest that are material or whatever in any of these companies? So yeah, but it's a judgment call. And I wish there was I wish I had a better explanation. I wish they said, 5% is okay, 6% is a no-no, but they don't do that. One of the hard things about auditing is that so much of it is, the whole thing is judgment. Okay, now, so this up here, these are the rules for immediate family members. Now, there are other people that you have to be careful of, and that's close friends, let's call them friends and relatives. You guys all know what friends are, so let's go to the close relatives. Close relatives are people like your parents, siblings, and non-dependent children. So you have the following rules. Okay, so your parents, brothers and sisters, non-dependent children, so children that have moved out, those would not be considered in your immediate family. They would be considered in your close friends and relatives. Okay, so here are the rules for them. They may have direct or indirect financial interest if the are immaterial. So they can have direct or indirect financial interest if they are immaterial. They may have material interests if the investment is unknown to the covered member. Okay, let me this a little bit. Okay, so parents, siblings, your parents, your brothers and sisters, and non-dependent children, they can have direct or indirect interest as long as they are financial interests, if the interests are immaterial. Covered members, they may have material interests if the investment is unknown to the covered member. Now, immediate family you're going to see every day, but some of these, it's not unusual to have someone. I haven't I haven't spoken to my father in 20 years. What investments does he have? No idea. I haven't spoken in 20 years. I haven't spoken to my brother in 20 years. Whatever it is, if you don't know about it, it can't influence the audit. So again, here is one of those things. Well, how can you prove you don't know about it? It's hard to come up with. There's really no way to do that. That's proving a negative, which is impossible. But anyway, the rules are that if they know about it, now there could be proof that they do know about it. Maybe the father sends them a copy of the will, and the will has this IBM stock in it. That is proof that it did, but you can't really prove the negative, that you can't prove that you didn't know about it. So anyway, if you don't know about it, though, if it's unknown, it's not considered a problem. So, and there's actually been lawsuits on this one. I'll talk about it in a minute. So let's go back to here. Let's do some of the cases. Oh, we got 4 of them on this one. Okay. So let's kind of go through this. So this is for close relatives and friends. Okay. Oops. Wanda is a member of the audit engagement for IBM. Okay, she's a covered member. She does not own any shares of IBM, but knows that her sister owns 500 shares. The IBM stock investment is immaterial to her sister. Okay, so her sister owns 500 shares, it's immaterial. Okay, is this a direct or indirect interest? What do you think? It's direct.
Direct.
Yep. Yeah. IBM stock, she owns 500 shares of the IBM stock. It's a direct interest in IBM. It is immaterial. Oops. Material's the wrong color. That's the hardest part about auditing, figuring out the colors for it. Okay. So covered member, it's a direct interest. It's immaterial. Is Wanda in violation of the independence rules?
Yes.
Actually, no.
No?
It's immaterial. So if it's immaterial to her sister, yeah, she is not in violation. So it's direct, but it's immaterial. Okay. Stacy. Member of the audit engagement team. Covered member. She does not own any shares of IBM stock, but knows that her brother owns 300 shares. Oops. Okay, so her brother has a direct interest. The IBM stock is material to her brother. Is Stacy in violation of the rules?
Yes.
Yep, it's material. So, the difference between these two, even, what the 500 shares, whatever Wanda's sister name is, Wanda's sister, 500 shares is immaterial to her, but the 300 shares are material to Stacy's brother. So this would be in violation. Again, are these, so it isn't a number of shares. It isn't like 100 is material, and it depends on who owns it. So the difference between these two are simply because of material or immaterial. So if it's material, it is in violation of the independence rules. Okay, Lawrence, any question on that one? And this kind of, these two kind of drive home the point that the materiality is in relation to what it is to whoever owns it. Okay. Lawrence, member of the out engagement team. He does not own any shares, but his father has a material investment in IBM stock. Wait a minute. I remember his father has a material investment in IBM stock. Okay. Is this direct or indirect?
Direct.
Yeah, probably direct. It's possible you have material investment indirectly, but probably direct. It looks like it's investment in the stock itself. And they tell us that it's material. Is Lawrence in violation of the independence rules? Oh, he did. He does not know about this investment.
Wouldn't he still be in violation even if he doesn't know?
No, he doesn't know about it. So if he doesn't know about it, it'd be, he'd really have no way of knowing if he was not independent or not. So again, this is one of those strange things. Could someone's friends or close relatives have a material investment and they still be independent? Yeah, if you don't know about it. So this is kind of a strange, kind of a strange set of rules. But if you think about it, if they didn't know about it, it would have no impact on the audit. Okay. May is a member of the audit engagement team. She's not on any iShares of IBM stock. Okay, well, let me. In the audit engagement team. So she is a covered member. Her mother has a material investment in IBM stock. Okay, I'm going to say that's direct. It could be indirect too. It wouldn't matter in this case if it wasn't direct. And oh, wait a minute. Darn it, I got my things wrong here. Okay, so covered member direct material. Minnie knows about the IBM investment and asks her mother to sell it. Her mother refuses to sell the stock. Thanks, Mom. Is May in violation of the independence rules?
Yes.
Yep, she knows about it and it's material. This one, I know there have been law cases on because people have, I've made the, I think, correct argument that look, through no fault of my own, right? I'm not independent on this because of these rules, and I don't know how all of them have been decided, but this idea that they know about an investment, but whoever the relatives are, they're not going to, basically, you have a right to make a livelihood. There is a kind of rules around you have a right to make a livelihood, and that's kind of what this falls under. So someone say, you can certainly see someone reasonably argue, I have no control over my mom, and she has this stock and she's not going to sell it. But I needed, I got the degree, I got the license, I need the job, and I'd like to do the audit. And again, through no fault of my own, it's in someone else's hands. So, but wait, these are the rules though. Is if you know about it and it's material, then the member is not is in violation of the rules. Okay, let's stop there. And then we'll take a break. And when we come back, we'll do something a little different. Hey, why isn't it? Okay. And when we come back, we're going to go into the monetary unit sampling, and I'll pull that up here. I'll put on here, say, be back at what time is it? 7:01. So let's say 7:11. Oops. And we'll start the monetary unit sampling. Okay. Okay, the next thing we're going to go over, we're starting on monetary unit sampling. We'll finish up the other handout. We should be able to finish up next week. But anyway, monetary unit sampling is a type of sampling that is used only by auditors. So it's a type of auditing that is, no, excuse me, a type of sampling that is only used by auditors, is directly used by auditors and no one else. The the classical sampling that we had, excuse me, the classical sampling that we had done before, you could use that for a lot of things. You could use it for anything that you needed. If you were at a lumber yard and you wanted to see, the 8-foot 2x4s, how long were they actually? You could go and get an average of it. Okay, this one's quarter inch longer, this one's a quarter inch shorter, and blah blah blah. You could get an average of it, and do a projection as to how big they really are and all that kind of stuff. This method is not like that. This method is only for auditing, and it's kind of weird, and but it has some real advantages in certain situations. It can't be used in all situations, but in certain situations it has an advantage. Okay, so let's take a look at it. Oops, let's get rid of that. Okay, so the client has the following data. So here's the book value for all of their accounts. And here's the cumulative total. So this is adding up all of these counts together. So it's sort of like this. The first one is just 500. The second one, this is the 500 plus the 200. So 500 plus, so this cumulative just keeps adding it all up. So the total amount of these accounts receivable is 5,000, and if these just keep adding up to, for instance, this one down here would be that one plus, oops. Making me a mess out of this. No, what are you doing here? There we go. I don't know if that was worth it, but anyway, so this just keeps adding them all up, and we're going to use this cumulative total thing is what we're going to focus on when we do these. I'll look at that in a second. And this audit value, this is what we're going to compare to the book value. Here's the book value, and we're going to compare that to the audit value. It's kind of like what we did before, but we're going to do it in a little bit different way. Okay. A sample size of 5 items was selected. So we have this $5,000 of accounts receivable. We're going to take a sample size of 5 of them. Okay, I'm going to stop this and switch cameras for a moment and tell you how we're going to do this. Sorry, that's really not right. Hey, there we go. Okay, so here's what we're going to do. So the accounts receivable are $5,000 of accounts receivable. And we're going to pick 5 items. What we're going to do is split this $5,000 up into equal chunks. So these will all be $1,000 chunks. They're actually not called chunks. These are called intervals. So these are $1,000 intervals. So here's what we're going to do. We're going to take item number 1, and it's going to represent that entire $1,000 interval. That one item, whatever it is, it'll represent that entire one. Number 2, you guessed it, will be the second one. You don't need to fill all these in, but we're basically picking one item from each of these groups we set it up, and we're going to use that one item to come up with what the misstatement is, the projected misstatement of this total. Okay, so we're going to split it up into five $1,000 chunks. Okay, we're going to do it by the cumulative total. So we want to find, when it comes to the cumulative total, we want to find the item that crosses from the first to the second. So we're looking at the $1,000 mark. Which item goes across that $1,000, that first $1,000 threshold? Okay. So looking at these cumulative total, which one goes past the $1,000? Which item?
Number 3.
So this is going to be our first item. Let me highlight that. Okay, so the first one's going to be item number 3. Okay, which one goes past the $2,000 mark? Which one? So now we're on to the second. So we picked the one that went past the 1,000. Now this one's going to be who goes past the 2,000. So which one goes past the $2,000 mark?
Is it
6.
So 6 is going past that. So we'll take number 6. Which goes past the 3,000?
line 7?
Yep. And 4,000?
9?
Yep. And then the last one, in this case, will just be the 10. Oops. Give me 1 second here. So 9 and 10, I think that should round out our. Is there 5? Yeah. Okay, so 9 passes the $4,000 and 10 passes the 5,000. Now, what this kind of is, this is similar to the ratio method we used before, that there's a ratio of audit to book. So we're going to take the audit and the book for each one of these and then multiply it by the interval, and that should give us the projected value and, more importantly, the projected misstatement. Okay, so number 3, audit amount was 600. The book amount was 600. So that one item, everything's fine with it, right? The interval is, oh, I didn't put it in here. What am I doing? Who's run this stupid class? Okay, the interval is, oops. 5,000 divided by okay, so we're gonna have a $1,000 interval. Oh, and we should put these in too. 3, 6, 7, 9, 10. And so, okay, so back to this, sorry. So 600 divided by 600 is just 1. So the projected value of this would be the entire 1,000. And the misstatement would be 0. Everything's okay with it, right? It's got, these two are exactly the same. The interval is the same as the projected value. We're rejecting that this entire thing is okay because of this. These are okay. So because that's okay, this will be that first interval is fine, right? The first one we picked, item number 3 is okay. Let's go to number 6. We have an audit value of 560. And the book value is 800. Okay, so we have a problem there. Does this look confusing? No. All right, so we're going to multiply it by the same 1,000 interval. So 560 divided by 800. Uh-oh, where's my calculator? I gotta go later. Okay. Oh, you gotta turn the calculator on. Write that down. Turn on the calculator. Okay, 560 divided by 800. 70. No, I could do that in my head, right? 700. Okay, so of this interval of 1,000, we're saying that 700 of it's okay. So what would the projected misstatement be for that interval?
300.
Good. So we're saying that this projected value is really only 700. So projected misstatement is 300 for that one. Well, this interval of 1,000, it's only really worth 700, according to our sampling technique. So this is a misstatement of 300. Okay, over here we have what number 7 is 450, 450, and 450. Okay, so number 7's okay. Hey, it worked. Number 9 is the audit amount is 300. And the book amount is 750. Times 1,000, whatever that equals. 400. And so the misstatement here would be what? 600? So we take a look at this item in the sample, we take one item, we say it represents the entire interval, say, okay, it's really only worth 400, so the misstatement is going to be 600. Okay, last one, 900 and 900. So everything's okay with that one. I'm going to copy this. I'm going to teach you guys how to be lazy, like me. Okay. So these intervals all together will be the same as the book value. The projected value here is how much?
4,100.
Yep. And the misstatement, this is one we're really interested in. This is what, 900? Okay, so here, I'm gonna copy that. So the misstatement we would project to be 900. Put on that. Now, here is the real beauty of this system. Well, first of all, any questions on how to get to 900? Okay, so here's the real beauty of this system. It picks one item to represent the entire 1,000, right? Now, notice if this one item is big enough, if it's bigger than 1,000, there's a 100% chance it's going to get picked because it's going to cross one of the intervals. It might cross two of them if it's big enough, or three, or whatever. But if this item we pick is large enough, it will definitely cross an interval. So here's the beauty of this thing. Oops. Hold on a second. So if it crosses that interval, $1,000 interval, it's going to get picked. 100% sure it's going to get picked because it'll cross at least one of the thresholds and maybe two or whatever. So here's the thing that's great about it. If you have a client that is, say, cooking the books, the more that they cook the books, the more likely they are that that item is going to get picked. And at some point, if they increase a sale or something like that to over the interval, it's 100% sure it's going to get caught. So if someone were to, say, cook the books and make an item over $1,000, 100% sure it's going to get caught. Not only that, even if it wasn't 1,000, it's more likely to cross the threshold the more that they increase that item or any of the other items collectively. It's more likely to be caught. So the beauty of this method is if someone's trying to overstate their books, sales, cash, accounts receivable, whatever. If they're trying to overstate how much they're, any of those accounts, the more they overstate it, the more likely it is to be caught. And if they overstate just one item over the interval, it's going to get caught, 100%. So this is a method that's very useful in some situations for auditors. This method is terrible for understatements. If they understate it, it's less likely to be caught. So this is really only for overstatements. So the overstatements are what we're really going to focus with this method. If it looks like it's going to be understatement, we don't use this method. Then you use the classical sampling. So overstatement ones, and this also does well, let's go back. Do something here. The items we pick, are they more likely to be large items or small items?
Large items?
Yeah, exactly. The larger the item is, and by the way, the more significant it is. You know, for instance, you're way more interested in this $900 account than say you would be in this $200 account. It's more likely that the $900 account is one going to put it over the interval, more likely than the 200. Now the 200 still has a chance. It's not like you're eliminating it, saying it won't, you know, it can't be the one that crosses the interval. It can. However, it's more likely that 900 is going to be the one that does it. The larger items are going to be the ones that are more likely to be picked. And you can kind of see that even in here. This is kind of a little contrived example, but the smaller items generally don't. It's kind of big, but you know, they generally don't get picked. The larger items are the ones that are more likely to get picked and more likely to go through the, you know, so you're also more likely to get more relevant information from it. Any questions on that? Okay, so again, this method, overstatements, it's great. The more they overstate the financial statements, any of the accounts, the more likely it's going to get picked. And at some point, if any of those items go over the interval, it's 100% it's going to get picked. The downside, if it's something that's understated, say like liabilities, expenses, things that people would understate, this method is not really good at that because it's not made to find those. And if we do find them, we actually ignore them. You know, I mean, that, you know, that's kind of what just how much that this is only for the overstatements. Okay, now there are little quirks to this, and we're going to pick the sample size, and we need to get our first introduction to our reliability factors. So if you go to page 2, and we're going to pick a sample size. Now, this is going to look a little confusing because, well, it's the first time we've done it, but basically picking the sample is way easier in this monetary unit sampling. It's a much easier to pick a sample than it is in classical sampling. And it's that way for 2 reasons. The actual formula for picking the sample is much easier to use. And it automatically picks the items that you should to go into the sample. Whatever crosses the threshold, it's picking them. We're not looking at a random number table and go 2 columns over and, you know, going down, and we don't do any of that. Whatever item crosses the interval, that's what we pick. So picking the sample size. Okay, so this is our monetary unit sample size calculation. And we have the book value. We have a tolerable misstatement. So this is what we would say would be material. You know, this is the material amount. So anything larger than that would be bad. And then we have the expected misstatement. And this might come from, say, previous years or something like that. But this expected misstatement, what we expect it to be off of. And this is just how sure do you want to be. So if you want it to be 95% sure, the incorrect acceptance would be 5%. So, okay, we're going to let we're going to audit down to the 5% level so that we're 95% sure this is the right amount. Okay, and here is the formula. Kind of wacky. Let's go ahead and fill in the numbers we know. Total book value is the 1.6 million. We don't know the reliability factor. The tolerable misstatement is this. Expected misstatement is 5,000. Yeah. Okay. Okay, now we have some numbers we got to fill in. And this first one is reliability factor at 0 overstatements. And you're running, what in the world is that? Okay, we're going to go down here. Here's our reliability factors. Here is our 0 overstatements. And you might say, well, why are we using 0? Well, 0 is used for the reliability factor for sample size, which is what we're doing, and for basic precision, which we won't get to till maybe next week. Okay, so 5%. Reliability factor is 3. Okay, I'm going to copy that. So we'll have 1,600,000 times 3 divided by 120,000 minus these two, and we need an expansion factor. Make that green. Okay, so we have reliability factor, and underneath that, hey, we get the expansion factors. And expansion factors are even better than reliability factors because there's only one row. So at 5%, it's 1.6. And copy that. Okay, so we have 1,600,000 times 3. Make a Mr. Calculator. 4,800,000. What am I doing? Hold on. Let's try that again. So this top row here, we'll make these all yellow. This top row here will be 4,800,000. Oops. The bottom row will be 100. Well, first of all, let's do this first. These are in parentheses. So 5,000 times 1.6 is 8,000. I mean, I better do it. So 5,000 times 1.6 equals 8,000. So 120,000 minus 8,000. I'm making this more confusing, I think. All right. 112,000. So that'll be our interval. Or no, sample size. First, sample size. $42.85. We rounded up. We'll round to the nearest whole number, 43. We're running to the nearest whole number because we can't take 0.85 of an item, so we're gonna round it up to 43. So that'll be our sample size. Take 43 items. Now, the question is, what's our interval gonna be then? If we're taking 43 items, and the book value is 1,600,000, this will tell us, you can round off to the nearest dollar. I'm gonna round it off to the nearest dollar. There's nothing wrong with leaving the cents in, but part of my teaching you how to be lazy is round it off to the nearest dollar. 37,209. So that will be our interval. Whatever item crosses 37,209, we're going to pick that item. The next one would be at what is it? 74,418 or whatever it is. Whatever it is, 2 times that is. So this is going to be our interval. And this is going to be our sample size. And just so you know, the beauty of this is really amazing because we didn't go over how you pick a sample in classical sampling, and there's a good reason. You can look it up in the book. It's a lot, and the big thing is that you have to get a standard deviation before you. For classical sampling, you have to find out a standard deviation before you can pick the sample size, which means you have to do a pre-sample of your items before you pick the true sample. So it can be kind of a hassle. It can take a long time to pick it. Notice, I mean, this is the first time we did it. We did what, 10, 15 minutes. We picked the sample size, and it told us which ones to pick. Every 37,209. Yeah. So it told us how many items, 43, and it told us which ones to pick, the ones that cross 37,209 intervals. Oops. What happened there? Oh, look at that. There we go. Great big giant interval. All right, so let's go ahead and do this other one down here. Oh, see, my giant interval threw everything off. Okay, so we'll do the same thing down here and see what you come up with. Now, be careful on this one though, because the risk of incorrect acceptance is now 10%. So down here, we have reliability factors. And again, be careful, this is at 10% this time. So this will be 2.31. So let's see. And down here, the expansion factors. At 10% is 1.5. Okay. So, let's see. 2,500,000. Okay, so that's what that would come out to. This one will be 60,000. Minus 6,000. Wait, 6,000 times 1.5, whatever that is. 9, right? 9,000? 6,000, yeah. 6,081, yeah. So, how come these are? Oh, I know why. Yeah. Same thing here. Hey, look at that. Oh. What's going on here, but everything green. Okay, so this is, well, 60,000 minus, was that 51,000? Oops. $113.3. So this is rounded, it'll be what? 113 items. Yeah. Okay, so this will be the number of items that we have. And so our interval will be the 2.5 million book value divided by 113, whatever that is. I'm gonna run off the nearest out. 22,120. 24. So this will be our interval. We'll take the first 22,124, the next one will be at what, 44,248, so on and so forth. So it picked the sample size. We got the sample size in about 5 minutes. And then it also tells us which ones to pick. So actually, picking the sample is much easier with this method. Let's stop here, how about? Okay. Any question on that? A little bit quirky. These two tables are kind of quirky, but you know, overall it's not too bad. Picking a sample size is even though it's kind of wacky looking, it really is much easier than doing the classical sampling. Even the first time is easier than doing it for classical sampling if you know what you're doing in the classical sampling, because it's just so much quicker. And it's really quicker at picking the sample of the items. Okay, nothing due this week. We're still working on chapter 3. We're still working on the monetary unit sampling, but there is that exam, chapter 1 and 2 exam. So if you have not done so, get that in by this Friday. Any questions on the exam? No, don't say anything. All right. Well, I think I've had enough. If you guys, I think we'll call it a week. So I will see you guys again on next Tuesday. Yeah, Tuesday.
Professor?
Yeah.
Would I be able to talk to you after class really quick?
Sure, absolutely. Yep. Okay, so goodbye, except for Nicholas, right?
Have a good night.
Thank you.
Yeah.
Good night.